So just a few weeks ago, I started a brand new dividend portfolio on Freetrade, and loads of you loved the video and enjoyed watching it. And as promised, I wanted to make sure that I keep you fully updated along the way with any changes, buys or sells, or anything at all. Since starting the portfolio, I've made a couple of small changes and I've added a new position in a company and added a few more shares to the rest of the portfolio. Mainly thanks to selling some of the free shares that I've been given from you guys signing up to Freetrade. So thank you for that. Every little helps and it will be getting reinvested back into this portfolio. I've not seen any free shares worth £200 just yet, more like £3.50, and that seems to be the popular kind of amount at the moment. If you do want to join me and open an account and get yourself invested, feel free to use the link in the description below and you'll also get a free share from the platform. Firstly, let's just take a brief look at the performance and the overall portfolio. I initially started with £1,000 spread across some big FTSE 100 names here. From the top, as a reminder, here's what we have. HSBC, Vodafone, Unilever, Diageo, GSK, National Grid, Legal & General, Tesco, Aviva, and finally BP. What is already pretty crazy is that only 1 out of those 10 companies is actually currently in the red. Every single stock is up, and some have even made double-digit gains in just a few weeks, which is crazy. As a reminder, this is not a normal market at the moment. Getting double-digit gains in a short time scale makes me nervous, but hey, this is 2021, so anything can happen. Either way though, remember this portfolio is designed to be a long-term hold, if anything, maybe even lifetime. I want to possibly make something that could generate income or cover some living expenses eventually, many years in the future. Let's have a quick look at the top performers before talking about the stock that I added in the portfolio recently. The top 3 are GSK, Vodafone and Diageo, all 3 massive household names, certainly in the investing world. GSK is up over 11% after releasing its Q3 results at the end of October, which the market reacted to very positively indeed. There were lots of positive numbers from the report, and some of the highlights included revenue is up 10% to £9.1 billion, earnings per share were up, 19p dividend announced with the expectation for 80p for the total year of 2021. As a reminder, GSK have been paying dividends for years, often increasing this amount. It generates lots of free cash flow, is very profitable and operates around the world too. A great staple of a company to have as part of a well-diversified, balanced portfolio, in my opinion anyway. Coming in a close second is Vodafone and Diageo. Vodafone's an interesting one because this company's been performing pretty poorly over the last few years in terms of capital growth, but they did release results literally today as I film this video, and they've been reacted to pretty positively, more than previous announcements, up over 6% today as I'm filming this. In the UK, revenues jumped 6% to €3.2 billion in the 6 months to the end of September, although part of this jump was due to a favourable exchange rate. Customers also started travelling again, boosting Vodafone's bottom line through roaming charges and visitor revenues to the UK. Nice to get some good news from the company, which currently has a very healthy dividend yield based on its slightly depressed share price. And finally, Diageo is performing well and was just boosted by 2.4% after the world's largest spirit maker forecast stronger sales growth for 2023 to 2025 of between 5% and 7%. If you've never heard the name before, the company owns 200 different brands of alcoholic drinks, and this includes Johnnie Walker, Guinness, and many more. They are very profitable indeed and have a strong balance sheet. Another great long-term hold with a sensible but small 2% dividend play. This stock is great for growth. So the big question, what did I add? Well, I took a position in Rio Tinto and I did this for a couple of different reasons. Firstly, I realized that I had no real exposure to this section of the market in my portfolio, and I knew that I wanted it to be pretty well diversified. And secondly, I knew this is a high quality long-term hold company, which currently has quite an inflated dividend because of all the cash that the company has generated. I don't expect it to stay this way, but if you did look pretty quickly, you'll see that the stock says that it's yielding a ridiculous 13.87% based on the data on the Freetrade app. This certainly beats any savings account on the market. Let's take a bit more of a closer look at Rio Tinto to give us a good idea of what this business actually does. Rio Tinto is a mining company, second only to the largest in the world, and has a market cap of over $100 billion. It's headquartered in the UK, but it's listed on multiple exchanges around the world. As you can imagine, there's not much mining going on in the UK for copper, diamonds or gold, unless they're built under many of the houses and are right underneath us, who knows. This company's been going for quite some time, founded back in 1873 and has now got 47,000 employees all around the world. Now, let's take a quick look at some of the high-level financials to give us a good idea of what shape the company is actually in. Starting from the top, this company's been growing revenues over the past 5 years, nothing hyper-growth but steady nonetheless. We've gone from 33 billion in 2016 to 44 billion in 2020. And then let's look at some of the figures and the gross profit and work our way down from there. For the last financial year, we had $18.7 billion in gross profit, which been divided by last year's revenue gets you 42.5%. Certainly nothing to be sniffed at. Looking slightly further ahead on the trailing 12 month, we're seeing even healthier numbers with revenue at $58 billion and gross profit significantly jumping to $29 billion, making that a gross margin of close to 50%. As we scroll down to our key metrics, net income looks nice too with $9.7 billion in 2020, although take a look at that trailing 12-month net income at $18.7 billion. That's what's paying your special dividend, which was paid out this year I should say, pushing the dividend yield through the roof. Secondly, let's just have a look at the balance sheet. As we all know, as much as profits look good, if you have a lot of debt, you can really get yourself in a bad position when times are tough. Looking at last year's numbers, we can see a healthy amount of cash and equivalents, just over $10 billion here, and then a total current asset number of $20.8 billion. Most of the other assets are longer term, bringing us to a total assets of a whopping $97 billion. This makes sense for a company like this. Think of all of their property, mining equipment and machines that would be in the business that would take a bit longer to liquidate in the event of a sale. Total liabilities coming at a whopping $45 billion, most of which you can see here is long-term debt, which has been getting paid down slowly as we can see. Thankfully, this means that companies covering itself nearly 2-to-1 of assets against liabilities, which is a big tick in the box for financial health. From a qualitative standpoint, this is a sector that's very profitable and produces the raw materials that lots of different sectors need. This means that its customer base is broad and the barrier to entry is very high indeed. Neither me or you could create a mining company tomorrow. It would be very time consuming and very costly. So we know that their competition is pretty limited. Long-term prospects should be looking good, so long as we don't have any breakdowns or any commodity prices or any other major global events that we may have seen in 2020. If anything, we all rely and need raw materials in the supply chain, and seemingly people can't get enough as we produce and create more and more things on the planet and sell them to customers all around the world. Certainly an interesting company. Please make sure you do all of your own due diligence. I'm no expert and do not consider myself any kind of stock guru, and I'm not a professional advisor by any means. So please do your own research, but go through the financial statements. They're all there for you to see, and have a look and let me know what you think in the comments below. I would much prefer a smaller dividend yield with some good capital gain along the way. So we should definitely expect this to reduce over the long term. Don't fall into the dividend trap of just looking at a company based on its dividend yield. It's usually high for a reason. This company's seen some pretty crazy results over the past year as prices of commodities have soared. They're also very profitable too, if you look at their figures for gross margin and net income. Looking at some of the analyst predictions for this stock over the next few years, the average seems to be around $88 mark, providing some growth, but mainly we're in this one for the dividends, which I'll certainly be reinvesting as soon as they get paid. The next dividend payment will likely be announced in March, so we'll watch this space, and then we'll see also if we get any special dividends too, which are one-off payments for market-beating performances that we had just in the year gone by. Either way, we're in this stock for the long term, so stock price for me right now is not a major concern. Before we wrap things up, I'd love to know your thoughts in the comment section below. Do we think we have every company we need now in this portfolio? Are there any major ones that I'm missing out on? Or do you think our job is now just to get those dividends rolling in and to build up those positions? I do have some spare cash to invest in my Freetrade account currently. I was thinking on loading up on a few more Vodafone shares, but I would really like to get your thoughts below on where the spare cash should go. I'll make sure I do another portfolio update on this one in a few more weeks or months' time, depending on how the schedule looks. But until then, good luck if you're just starting out. I hope this gives you a bit of confidence to get started. Do remember that this is just a small part of my overall portfolio, and I'm sure I'll get around to covering the full portfolio update at one point, maybe once we get to the 1,000 subscriber mark. A huge thanks to everyone who's joined us so far on this journey. It's great to see. Anyway, let's wrap things up for this update. Drop me a like if you found the video interesting. Subscribe for those who aren't already for many more videos. I'll see you guys in the next one. And as always, happy investing.